All right. If you're serious about investing, you need to know about public.com. That's where you can invest in everything: stocks, options, bonds, crypto. They even offer some of the highest yields in the industry, like the bond account's 6% or higher yield remains locked in even if the Fed cuts rates. What sets Public apart is how they give you the tools you need to make informed investment decisions. Their built-in AI tool called Alpha doesn't just tell you if an asset is moving, it tells you why the asset is moving, so you can actually understand what's driving your portfolio's performance. Public is a FINRA registered, SIPC insured US based company with a customer support team that actually cares. Bottom line, your investments deserve a platform that takes them as seriously as you do. Fund your account in 5 minutes or less at public.com/investing unscripted and get up to $10,000 when you transfer your old portfolio. That's public.com/investing unscripted. Paid for by Public Investing. Full disclosures and podcast description. Hey, everybody. Welcome back to Investing Unscripted, where we ask and answer the hard questions about investing. I'm Jason Hall. He is Jeff Santoro. Some people around these parts call him the voice of the people. Hey, buddy.
Hey, how are you?
I'm fantastic. I'm doing incredible, actually, right now.
Wow.
Yeah. It's a version of like the runner's high, but I wasn't running before this podcast.
So you're just high?
On endorphins.
Okay. Thank you for clearing that up.
Yes.
This is a family show, so we want to make sure that we're clear.
Family show.
We've been a family show ever since my niece wanted me to talk to you about your language.
It's not just your niece. It's like other listeners have sent stuff in too.
Yes.
And my response in the past has been something along the lines of, those people. I'm kidding, listeners that don't appreciate the profanity. I've tried to do a better job cleaning it up. That specific instance was, if you'll notice that it was bleeped, that was for our friend Tyler Crow. Apparently he loves it when we bleep stuff.
Well, now you're going to have to bleep that again.
Well, no, I will, but I might just bleep like non-profanity.
Yeah.
Because if you hear the bleep,
do that, I want you to know, I think Tyler is a...
Oh yeah, that's true.
Anyway.
It's a family show. You shouldn't say that kind of thing.
This is getting silly.
So today's show,
show.
We're doing something a little different, something we want to do a little bit more of. And we're calling this being honest about your stocks. The longer version is, hey, dude, you need to figure out how to be honest with yourself about your crappy stocks. But that's a lot of words.
Except not us, because our stocks are amazing.
They're amazing stocks.
Amazing. Perfect. They're the perfect stocks, really.
No, what we're going to do, we've each picked a couple of stocks from our portfolio that are some of the largest stocks in our portfolio, not based on returns, but based on cost basis. So the amount of capital that we've invested into them, using that as kind of a proxy for our conviction into these businesses as investment ideas. And we're going to put them through a framework of questions. We're going to talk about what they do. And we're really going to try to focus on how have they actually done the business, not the stock. We'll talk about stock performance, but we'll also talk about focusing on how is the business actually done, contrasted against what our expectations were, and try to come to some conclusions about, are we really properly evaluating these stocks in the way that we think about them? Am I leaving anything out with that, Jeff?
No, you nailed it. We have 5 or 6 questions we're going to ask each other, interview style. We'll do it relatively quickly so we can get through all 4. And I'm going to go through mine quickly.
Thank you for the clarification.
Jason will not, because he's incapable of being brief. And then we'll see where we end up at the end. This is a new thing we're trying. You want to go first?
I can go first. And let's go with, which of these two should I do first? Which do you think?
Let's do Live Oak Bank, because we talk about Enphase a decent amount. I don't think we talk about Live Oak that much. So let's give it leadoff hitter status here.
Yeah. So Live Oak Bank, ticker LOB. Let's start with, where do you want to start?
Let's do this in case people aren't familiar with it. Let's just give like the 30-second pitch about what it does. What is it? What does it do?
It's a bank.
All right. Moving on to the next question. Oh, sorry.
And it does basically banky things. It lends money. That's its core income generating business, is lending money. Its deposit base is mostly just people looking to save money on the internet with a high, like it's people that are looking to get a good yield on their savings. So the good thing about that is that those are pretty steady deposits. And because of the way they've built their business, they can afford to pay high yields and raise them with interest rates moving up, be a little slower to bring them down when interest rates go down, to really outcompete the big banks with a high yield, to get that safe, steady deposit base. And then where Live Oak is different from most of the bank brand names that most people are going to know is that they're very concentrated in who they lend to. And specifically, they lend to small businesses. Their motto is to be America's bank for small businesses. That's their goal. So there's a lot of concentration there as a cohort, a lot of opportunity. To be a little more specific for those that don't know, they focus on specific industries that they lend to, where they've built out a knowledge base of roughly a dozen or so different industries that they've built expertise in. And the way they do it is they identify industries that the economics are really favorable to find safe borrowers because the profitability models of their business, finding industries that have some resilience to economic pressures, businesses that don't require a tremendous amount of debt that can create existential risk, but where good operators can use debt as leverage to fund things like growth, expansion, and then just be good borrowers and pay down that debt over time, wash, rinse, and repeat. This kind of debt is adjustable too. It's not fixed rate, but you benefit from when interest rates move up and you need to raise your deposit yields to your deposit base, you're going to raise rates on the loans that you have after the fact as well. So your net interest income is still relatively protected. So that's the short version. That's the business model. And they've developed some ability to take share and be better lenders because of their expertise than a lot of the small lenders and local banks that typically small businesses go to, because there hasn't been a lot of appetite from other banks. And that's a competitive advantage that they've been able to leverage. That's basically what they do.
All right. So we're going to focus most of the conversation for all four of these stocks around the business, but I think it is worth mentioning how the stock has done. Because as much as we try to stay focused on the business, the reality is everyone's going to look at that. So I'm going to share my screen here. I'm going to use our sponsor FinChat. All right. So on the right side of the screen here is the total return for Live Oak Bank shares compared to the S&P 500 over the past 5 years. So it has been around a market matching stock. If you go a little less frequent, if you go a little closer to current days, 3 years, it's been lagging the market.
The oldest positions that I have are roughly from August 2022, but the bulk of my investments in Live Oak were from the spring of 2023 when we were going through a bit of a banking crisis.
And you can see that dip right here.
Yeah. So for those of you listening to the podcast, it's pretty obvious that you go from the beginning of 2023 to March of 2023 when we saw three big bank failures between March and May, 2 within a week. And then in May was when First Republic was taken over by the FDIC. There was a few months there, a 3 or 4 month period where there was a ton of opportunities in banking. And I made some investments, Jeff, in banking and some big banks at the time, like Truist Financial and a couple of the other larger regionals that I wasn't intending to hold long-term. It was just, they were too cheap. And eventually the market was going to come to its senses and the valuations were going to come up, that I did sell within a year or so at a pretty good profit. But for Live Oak and a few other Access Financial banks that I want to own for long term, it was just a really good opportunity to buy. So the point is, though, Live Oak, I think this really matters for me from my holding periods overall, has been a laggard. It hasn't outperformed the market.
Yeah, and of the four we're going to talk about, I think we're going to both end up talking about ones that have not beat the market. So I think that's an interesting kind of discussion point. All right. So we talked about the stock has done both in your portfolio, but also just kind of generically over the past 3 or 5 years. Mm-hmm. So you have to do this in one sentence, Jason. What is your one sentence thesis for why you own Live Oak Bank shares?
Is there a limit to the number of words I can put in that sentence?
Sorry, that was your sentence. Be like, you are now done.
Take a giant breath. And then when I want to run out of air, the sentence is over.
Elevator pitch, man. You meet someone on the elevator and they ask you why you own it. What are you going to tell them?
They're leveraging the dislocation of access to capital for small businesses in ways where they can outcompete other banks while also understanding how to leverage SBA guaranteed loans in a way to keep a really safe book of debt to small businesses. That's the short version.
All right. That's good. So what do you track with this company? Like other than the normal stuff, right, that everyone tracks with every company, like what KPIs or key performance indicators do you look for every time Live Oak Bank shares reports to know that they are on track and that your thesis is intact?
One thing that I look at pretty consistently, and I do this with most banks, is I'm looking at net interest margin. Net interest margin is basically the profit margin for banks. It's the difference in what they earn on loans minus what they pay out on deposits or bank borrowings or other sources of capital that they've used. So this is useful because it tells you how banks are resilient through different interest rate regimes and interest rate environments. For example, if you look back in 2022, net interest margins were 3.87. It was almost 3.9%. In 2023, that fell to 3.4%. And last year it was about 3.3%. We've seen some impacts of interest rates rising, affecting its net interest margin to a certain degree. And I understand the mechanics of why that is. And that's really important because the loans that they issue, it's not like, oh, the Fed raised rates. Next invoice you get, Mr. Borrower, your interest rate's going up. They have a schedule. They can do it once a year or twice a year, whatever it may be. So there's going to be months and months that go by on loans where they will have already raised the yield they're paying on deposits to be competitive before they're able to raise their own rates, right? But we've seen that stabilize, right? And the inverse is likely to prove true as well, where when rates go down, they're not going to race to cut rates to depositors. Chip Mahan, he's been abundantly clear that he feels that most banks are taking advantage of depositors with the rates that they're paying on deposits. He's a little bit talking his own book, right? And promoting his own bank while he's doing it. But they will raise rates or they will lower rates faster on deposits than they will on loans, right? They can and they should. It's the mechanics of the way it works. So on the way down, it will benefit them. That's one part of my thesis is I do think from where we are now, rates are going to stay where they are or come down some. Over the next 5 years, I think rates will be a little lower than they are now. And generally that trend will be neutral by the end, but in the near term, it'll be positive for their net interest margin and lower rates will be more attractive for borrowers.
All right. What is your pre-mortem? If this investment doesn't work out, if you end up selling all of your position at some point in the future, what happened?
I think the most likely case is that the great idea didn't deliver outperformance as an investment. I do think that their growth rates have slowed and I can promise you that they could have grown their loan book a hell of a lot faster than they are. All they have to do is lower their underwriting standards, right?
Which is the thing every bank can do, by the way.
Yeah, exactly. Right. And that's great when the economy's good. But then when you see banks blow up, in many cases, it's because they lowered their underwriting standards. This is what caused the global financial crisis. Underwriting standards writ large were lowered. A lot of loans that shouldn't have been written were written. Then they were packaged together and sold off. And then those explosions all over the money economy carried through to blow the banking industry up. So at an individual level, for a business like this, losing their conservative, disciplined approach to growing while being smart about taking on the risk. The other side of that tension is the opportunity is not big enough to lead to outperformance, right? Where you just don't grow quick enough you don't grow your earnings enough to justify the price, or you don't grow enough, quick enough. So I think the most likely downside case is probably underperformance versus some sort of catastrophic event.
All right. How is the business done compared to what you were expecting? Has the result come anywhere close to what you were looking for? Or if not, why do you still own it?
So I think broadly, I think the business has done well. The challenge, Jeff, is coming through the pandemic because of its focus, just one of those just crazy confluence of events. Because Live Oak was focused on small businesses and knew the SBA process so well, it was in a perfect position when the government put in those, remember the payroll protection plan loans? These were government-backed forgivable loans. It was free money for banks. If you know how to do the process, it's free money. They're already talking to small businesses. They know how to do the SBA processes. And the financial results were incredible. The results of earned almost $4 a share in 2022. That was kind of the last year of the windfall of those. Earnings in 2023 were $1.64 a share. Just for comparison, so less than half. And then a modest amount of growth, $1.69 a share last year. So investors that maybe didn't have the best understanding of how that could impact the business have seen a little bit of pain, right? So I've expected that could be a challenging outcome. And if you look at the stock, if you go back to, again, kind of that mid 2022 period, we've seen the stock basically take a round trip. It fell a tremendous amount, like we were talking about coming into the banking crisis of early 2023, and then rode the market up higher because that banking crisis of 2023, the rest of the stock market was running and banks writ large did very, very well for all of 2024. So it rode right along with them. But since the election, just about all of those positive gains have been washed out of the stock because of concerns about trade and inflation and the impact on small businesses and their appetite and capacity to borrow money. The results have been very, very volatile. So, and I kind of expected that, but more volatility to the downside than I expected, honestly.
Hey, everybody, we'll be right back. But first, a word from our sponsors. FinChat.io is the complete stock research platform for fundamental investors. They have all the standard financial data on more than 100,000 stocks globally. But beyond that, they have company-specific segment and KPI data on around 1,800 stocks. So for example, do you want to see NVIDIA's data center revenue growth? They've got it. Do you like to track Apple's iPhone sales? They've got that too. Or how about nights and experiences booked for Airbnb? You guessed it, they've got it. And they just added around 8,000 ETFs and mutual funds to the platform. The breadth of FinChat's data is truly one of a kind. I use FinChat every single day as I'm researching the stocks in my portfolio, specifically when I want to see how they're doing on KPIs that FinChat is famous for. So to get 15% off any paid plan, go to finchat.io/unscripted. That's finchat.io/unscripted to get 15% off any paid plan today. The link will be in the show notes.
Investing Unscripted is brought to you by the Chit Chat Stocks podcast. That's right, another podcast you need to add to your listening rotation. My name is Brett, one of the hosts of the show, and I produce 2 episodes weekly along with my co-host, Ryan Henderson. On the Chit Chat Stocks podcast, we talk stocks from the hottest names to undiscovered gems, interviewing sector experts, studying super investors and why they are successful, and we have a fun time while doing it. Follow the Chit Chat Stocks podcast on YouTube, Spotify, or Apple Podcasts, and never miss an episode. That's the Chit Chat Stocks podcast.
All right, last question. If throwing everything you know about this company out the window, would you buy it today?
Yeah, it's funny. After we went through our process of picking these stocks and that we're going to talk about, and I went through it and took a look and started looking at valuations and thinking about the quality of the business, its prospects over the long term, I would probably buy more now. And the thing that's hard to throw out the window is that from when I made my initial investment, because of the way that I'm wired, I've studied the company a lot more and the opportunity in front of it and understanding their business and what they're trying to do. And I know the business far better now than I would have if I had not bought it before. So it's hard to try and remove that bias that I've built. But I would say that I have higher conviction in the business today than I did in August of 2022 when I bought my first position.
I have nothing else to add.
I'm perfect. It's a bank. I'm perfect. Okay. Enough about my perfection. But no, here's the thing. So I thought we had these questions put together before, Jeff, and I thought long and hard about that with this company because I mean, it can be the height of overconfidence, right? To have this, especially in a public format like this, to have this conversation and, come to and talk about an underperformer like this, when maybe the better conclusion is maybe there's less here than you think. But
yeah,
everything that I know about.
It's also hard to answer the question of would you buy it today? Because it's it is impossible to remove all of the research and understanding and bias that you have already in your head about it.
Yeah, no, it totally is. All right, let's put you in the hot seat here. You want to do, which of your stocks you want to do first?
Well, in the spirit of ones we talk about less, let's start with my less talked about one, which is Ryman Hospitality Properties. I have talked about it before on the pod, but it's not nearly as popular as some other stocks that we talk about. So should we start with the same question? What does it do?
Same question. What's its core business?
All right. So Ryman Hospitality Properties is a REIT, a real estate investment trust. And what that means in a nutshell is there's a lot of things that it means, but the main thing I think that's important is any REIT has to give 90% of its net income, at least 90% of its net income back to shareholders in the form of a dividend. That's how the business is structured. So right off the bat, you're getting a dividend paying stock here. What's interesting about Ryman is, unlike some other real estate investment trusts that, own land and then build a store and lease it out to a company, or like a Walgreens or something like that, they own the land and they own the stuff that's on it. So they own
They do the operations too.
Yes, and they do the operate. Well, yes and no. I'm going to talk about it in a second.
Right.
So,
Yeah.
so they own the Gaylord hotels. So if you've ever gone to any of these properties, there's one in Nashville, Dallas, Orlando, Denver, and Washington, D.C. And then those are the big Gaylord hotel properties, and they are literally cities under a glass bubble. I've been to them, and they are, the first time you go, it really kind of does. You walk in and go like, holy crap, this is crazy.
It's the hotels that are built for big events, conventions.
Right. Yeah, so that's the thing. It's not just like a Marriott. It's a hotel that you would go to for a conference. That's a big part of their business is large group events, and they have.
Although they did recently buy a Marriott 5-diamond resort, that fits with their profile in Texas.
Yeah, but the bulk of what they're trying to do is build or have hotels that you can come to for a big event. That's the biggest part of their business. They own and they own all those hotels. Now they are actually operated by Marriott. They pay Marriott a fee to have them do all of the hotel operations. So that saves a lot of, expenses on Ryman's behalf in terms of like employees and things like that. They also have an entertainment segment. So they own a bunch of entertainment venues, mostly in Nashville, but in some other places as well.
Right. The Ryman Auditorium, hence the name.
The Ryman Auditorium is the big
the Grand Ole Opry.
The Grand Ole Opry. They own a radio station in Nashville, and then a bunch of, just bars and entertainment venues downtown. And they've been pouring a lot of money into the business the last couple of years, renovating some of those entertainment properties, doing big renovations in these hotels, and in every press release you read about, they're redoing the large function space in this hotel, or redoing a chunk of rooms in that hotel, or redoing the bar and restaurant in this hotel. So they're constantly pouring money back into the business to keep these locations, top notch and attractive to groups coming in. So that's what they do. Using our sponsor, FinChat. By the way, if you want to check out FinChat, you can use our code and get a discount on a paid membership. So this is the Ryman chart compared to the S&P 500 for the past 5 years. So it has slightly lagged the market, and by slightly, I mean 40 percentage points. Going back further though.
So stay on that 5-year, because what I want to point out on the 5-year is, so we're recording this in early March 2025. So this is pretty close to the pre-COVID peak. At that point, the stock was pretty richly valued, but the stock within, 21 days of not even that. I think it bottomed on March 23rd. From that point, the stock is up a 4x from here, a 5x from here. And then more recently, I think it's worth pointing out that like with Live Oak, the stock's had a bit of a rough go of it here more recently.
Yeah. So and this is what's interesting about it. In my portfolio, it's actually almost break even, and I've owned it for about 5 years. I bought it around the time that it was completely crashing after the COVID pandemic started. But if you factor in the dividend, it's up about 4%. Now it's still lagging the market, or at least close to the market, I think. But that dividend does make a big difference. But what's interesting about that aspect of how it's done price-wise, you're right. It depends kind of when you bought it. It is not completely recovered in all metrics to its pre-pandemic levels, but it took a precipitous drop in 2020, as you can imagine, right? If this is a place that made its money on large group gatherings, and then all of a sudden that was done for quite a while.
Well, and there was the expectation too. You have to remember in March of 2023, we were weeks removed from the world basically locking down, with no idea how long it would take to get to the point with the pandemic where the risk was removed. They had like 3 years worth of cash on the balance sheet to continue operating though, and most investors were ignoring that in their race for the exit in most stocks.
Yeah, and it came back relatively quick. I mean, within 2 years. So by 2022, their full year revenue was back where it was, above where it was in 2019. But yeah, you didn't know at the time that it was going to turn around that quickly. So anyway, that's how it's done for me. That's how it's done as a stock. So yeah, not a world beater here, but it is my largest position by cost basis in my portfolio.
All right, so let's talk a little bit about why why you own it.
So
What's your one sentence thesis?
my one sentence thesis is this, and I felt more strongly about this when we were in a big work from home world, and we're in a little bit of a less one now, but businesses like to get together with their people in places. There are conferences for all sorts of organizations, businesses, associations. I've been to a bunch just through what I've done in my professional life. And this is a great place to do that. I've been to conferences at these hotels, and you understand why they are that way. They're
Right.
also not cheap. I remember going and being worried about how much money I was spending, not only just on the hotel, but on the food and everything. So from a consumer, you say to yourself, well, that sucks. But from a business owner standpoint, you say, that's great, right? You know, if people are coming to these hotels for these large events and spending a lot of money, that's good for the business that owns them. And I think the entertainment aspect, the entertainment segment is also interesting. They're putting a lot of money and energy into that. And I think that could be a larger part of the business as time goes on.
Yeah, I think you're right. All right, let's talk a little bit about those key performance indicators, KPIs and metrics. So it's a REIT, so funds from operations is obviously really important to measure. What else about this business in particular are you tracking to follow the performance of the business?
Like any company, I'm looking at revenues and earnings per share / FFO from, because that's FFO is the earnings per share for REITs. But I track them both. But I'm actually more interested in the hotel level metrics. So for example, they report things like, hotel occupancy, hospitality average daily rate, right? So that's for the hotel part of the business, the average daily rate, like how much they're making per day per room. And then they also give and this is a common metric in this space, something called RevPAR, which is
revenue per available room. Yeah.
Right. Revenue per, but they give two of them. They give hospitality RevPAR, which is just the room. And then there's hospitality total RevPAR, where they add in spending on the gift shops, the restaurants, things like that. And that significantly increases the RevPAR when you factor in all that other stuff. And then lastly, group room nights booked, which I think is an important metric for future business. And all of those, when you look at them as a chart, they all look exactly like you'd expect. Doing well, plummeting in 2020, and then starting to recover. Some of them are back to pre-pandemic numbers, other are not. I'll show a couple here real quick. All right, so for example, this is yearly, by the way. I'm not showing quarterly, just yearly data. They were hovering around, this is occupancy for the hotel. So they were hovering in the low to mid 70s pre-pandemic. It obviously dropped significantly, but interestingly, they have not come all the way back to where they were yet. So this is something I'm keeping an eye on. I think it's part of why the stock has not been a market beater. Now, here's that total RevPAR, right? So this is the revenue per available room that includes all of the spending outside the room. So this is recovered nicely, right? If you just look at this, pretending the pandemic didn't happen, it would just be a nice chart up and to the right, so this is done well. And I think that's interesting, as occupancy has not returned to where it was. They've been able to monetize the people who've come into the hotel pretty well.
Well, I think go ahead, and then I'll talk about
Yeah. And then the last one I wanted to show, this is the group room nights booked, right? So this is obviously another one that has pretty much returned to pre-pandemic, but not really grown much since then. So those are just a couple things that I keep an eye on quarter on quarter, just to kind of see how the business is doing outside of the top line financial data.
Yeah, and part of the analysis there that I think is useful is that with that RevPAR number moving higher, it's that they do have, whether it's pricing power or whether it's more of a measure of supply and demand, and that they have this supply, particularly outside of Las Vegas. Their properties are some of the most desirable for large conferences in the US. They've been able to raise prices is good. Looking at the occupancy, I know that's one of the reasons they took over they acquired the full stake in the joint venture, the Rockies Gaylord, was operationally, they wanted to really focus on that with their partner and be able to take a bigger piece of the pie at the same time. I think you're right. Those are key metrics to continue to focus on. Okay, talking about the stock, how it's made you money, but hasn't been a world beater here. Thinking through the results and the directions, has the result come in where you expected? And if not, Why or why not?
If you had asked me this in the years after, when it was started to do like the crazy year-over-year numbers as it was recovering from the super low pandemic stuff, I was smart enough to know not to get caught up in that. Like I didn't think it was going to grow at 300%, right? That was just coming off a really bad low.
Going from zero,
Right,
around here
exactly.
from zero, yeah.
But I didn't see any reason why once we were past pandemic, it couldn't get back on the exact same trajectory as it was. And I think because it hasn't in some areas, that's why it has not performed maybe to my expectations.
Mhm.
I also wonder if in a world where we are not as work from home as I thought we'd be a couple of years ago, I'm wondering if that part of my thesis doesn't play out as much.
Mhm.
But I think it's pretty much done what I've expected it to do. To kind of tie it to the question I asked you about what I think what could go wrong that makes this not a market beating investment moving forward is just that it just is okay. Right.
Yeah.
That's my biggest worry with this company is that it's just an okay performer over the next couple of years and then doesn't give me market beating returns. I'm pretty confident that it's a strong enough operator, and with the dividend, excuse me. And with the dividend, I don't think I'll lose money on it, but I don't know if we'll be in a scenario where it's outpacing the S&P 500 by any significant amount. My other concern that goes along with that is if they've passed along a lot of pricing power to customers already, how much more do they have? And, if we see a significant downturn in the economy, do groups and businesses pull back on things like in-person conferences? So that's my concern with the company right now. I think over the very long term, it'll be fine. But, it feels like we're far enough away from the pandemic that things have recovered. But another, an economic downturn in the next couple of years could quickly turn into a decade of underperformance, right? If you add the two together.
Well, I think it's notable too that the stock's down almost 20% in like 3 months here. So there's been a lot of, and just in terms of to get back to zero, the stock needs to gain 36% to make that 19.3% decline to get back to where it was. So just a normalization back to where it was a few months ago, there's a lot of upside. So that's interesting to me, but so that's where I look at it. But this isn't about me, Jeff. It's about you. Why do you still own it with those concerns?
I think because it's the long-term aspect of the way I'm investing, right? And it's the dividend. I've been wanting to have a little bit more dividend exposure in my stock portfolio. And rather than go learn about and find new dividend stocks that I'm not familiar with, this is one that I've studied pretty well and I know a lot about. So I understand that I'm probably presenting a bias in that sense, right? I could be overlooking some concerns about the business because I know it. But I also really like the management team. When I listen to them on the earnings calls, I don't think they're blowing smoke. I think they give it to investors pretty straight. The decisions they're making in terms of investing in the property seem to make sense to me. I don't get the sense that they're overly aggressive in terms of buying new properties or trying to open new hotels. It seems like they're focused right now on renovating the ones they have and expanding the entertainment part of the portfolio. I also just want to give a little more time to see if we're back to like a normalization in terms of people going to conferences and stuff like that. So I'm willing to wait this one out and see how it goes. Hey, everybody, we'll be right back. But first, a word from our sponsors.
All right. If you're serious about investing, you need to know about public.com. That's where you can invest in everything: stocks, options, bonds, crypto. You can even earn some of the highest yields in the industry, like the 6% or higher yield you can lock in with a bond account. Public is a FINRA registered SIPC insured platform that takes your investments as seriously as you do. Fund your account in 5 minutes or less at public.com/investing unscripted. Get up to $10,000 when you transfer your old portfolio. That's public.com/investing unscripted. Paid for by Public Investing. Full disclosures in podcast description. All right, let's play the impossible game. Flushing your brain of all of your experience with the stock and the company out the window. I think we know the answer based on the last thing you said, but do you objectively think you would buy it today, or are you waiting it out based on other things?
Assuming I did as much research and learned about it, I might still buy shares. Here's what I would probably be concerned about if I was just looking at metrics, right? I would probably see year-over-year revenue growth in 2022 of 93%, and then in 2023 of 20%, and then in 2024 of 9%, and wonder why it's decelerating. And hopefully I'd be smart enough to understand why, but it's not like everything is super trending in the right direction consistently. So that might give me pause. But if I dug in, I would like to think that I would see the potential that I see now. But I think I'd be lying if I was like, absolutely, no brainer, I would. Now, I feel differently about my next stock. I think I would absolutely right now, but they're in two different places in terms of performance. The other thing too is it's not like stupid cheap for a company that has been struggling. So I also might get caught up in valuation if I were looking at it fresh right now. I think because I have some anecdotal evidence too, I would probably pull the trigger and buy shares right now.
All right. I can support that. So Jeff, we've already taken a pretty good amount of time here to do these.
Yeah, I don't want to spend much more time with you.
Remember when I laughed about when you said we're going to get through these quickly?
Yeah. It's like you think I don't know you.
Me? I knew I wasn't going to breathe.
Mr. 27 minutes to explain Live Oak Bank.
It's a bank. I explained the bank quickly. Explaining myself is the hard part. It's the hard part. All right, well, let's do this. I have an idea. Let's try to lightning round these other two stocks. We've talked about them a lot, so I don't think we need to do the whole first part, what do they do, that sort of thing. So let's try to lightning round this a little bit. What do you say?
All right, I can do it. I can be as...
I'll show you the way. I'll show you how to do it.
I do not believe you. All right, let's go. Your second stock is...
Enphase Energy, ENPH.
All right,
and actually of these two, this is the one that's the largest by cost basis of any stock that I own.
What does it do?
I'm not going to tell you. Everybody already knows. They're in solar.
All right, how has it done as a stock? Both in
terribly. Terribly. It's terrible.
We'll skip the charts. It's done terribly, both for you and as a stock generally, right?
Yes, it's done terribly. The residential solar business is in the dumps. It has been a brutal past couple of years for the stock and for investors in solar, particularly in residential solar.
All right. So then why do you own it? What is your one sentence thesis?
This business has proven that it can make money across the economic cycles. It has generated free cash flow every single quarter through the downturn, while its peers have been burning money, not managing the cycle as effectively. This is a second sentence, bolt that onto it being a best-in-class product for residential solar that's required by law, and it's built to be a long-term winner.
All right. What metrics or KPIs do you follow with this company to tell you that it's on track as an investment?
So I look at unit sales, the units of the microinverter that they sell that go on the solar panels, because this helps inform what's going on with some sort of a recovery, getting through this downturn in demand. I look at gross margin, I look at operating margin, and I look at free cash flow. Those are the key things that I look at. I also look at units for their battery sales, because that's the one bright spot that has continued to grow even through this downturn.
All right. What is your pre-mortem? If this investment continues to go badly for you and you sell your position, why did you sell?
Because the solar market doesn't recover in anything like a quick time frame. We hit bottom, and the bottom just becomes the new normal for an extended period of time. And the price for the stock now just turns out to be the price for the stock. And it takes it a massive amount of time to generate any returns. And it ends up just underperforming the market by a pretty significant amount.
So have the results up till now in the time you owned it surprised you? Is this what you expected, or was this not a big surprise? And why do you still own it considering how badly it's done?
So this is a stock that I bought a long time ago, and then have bought a lot more, both buying shares and what we're talking about for cost basis. This is shares that I own. If you add in options that I've used,
shares you might own in the future.
Right. There's even more.
Yeah.
Right? It's even more. I've done those during this downturn. I held most of the shares that I own for the long term. I did sell some of them back in 2021, 2022, because the price had gotten just bonkers, just way out there. And I sold a little bit, but I kept most of it because I continue to believe in the business, and solar's place in powering the world. And this company has shown the ability to operate profitably in the area that it operates in. So I did not expect to see as sharp of a decline and as bad of a downturn as we've seen. But more recently, if the thing that they did that I didn't expect, that it's been just a ray of sunshine, is their ability to stay cash flow positive through this downturn. Very few companies can see the demand, or they can see their unit sales fall 60 or 70%, see revenue fall 60 or 70%, and still generate positive free cash flow without monkeying, like with selling all their inventory and not replenishing it or something like that. They haven't done any of that stuff. They've leveraged contract manufacturing, they've scaled it back, and they've positioned it to scale up when the market recovers. And that's a big pleased, unexpected thing that happened. The unexpected that was negative has been the big downturn.
All right, last question, the impossible one. Throwing everything that you know about the company out, would you buy it today?
If I had never bought it, again, I studied this company for years before I bought a share. And that was in 2018 or 2019 when I first bought my first position. I'd studied it for 3 or 4 years before that, and it intrigued me before that. I would say, yes, I probably would have outsized exposure right now because I take on risk in these situations. And like thinking about banking, the Live Oak story, I bought when there was the most risk and the most opportunity. And I'm doing the same thing with Enphase, and it could blow up. The options in particular could turn out to be zero, right? The calls that I bought may be worthless, and that's money that will just be a complete 100% loss. But I'm willing to take on that risk because I understand the opportunity, and I have massive amount of conviction because this management team has proven they know what they're doing. They know how to operate in this space. They've taken market share during this downturn, and the companies that are taking market share during downturns, those are the really, really good companies that are probably the biggest winners when the market does turn. Yeah, I think I would.
All right.
That was 5 minutes, Jeff.
I'll do mine in less.
It won't be as good though.
Yeah. I was going to say, I can only do it because I don't know as much as this of you too.
All right, let's talk about MercadoLibre, which is interesting because this one was in the running for me for one of my larger ones. So
yeah, so this is my second largest position by cost basis. I don't think we need to talk about what it does. We talk about this one a lot. So go ahead, shoot me the questions.
Okay, how's it done for you?
It has done very well for me. In my portfolio, it is currently up 38%, my position, and it is beating the market over the past.
Now, Jeff, I think this is one that you added to your portfolio relatively recently though, right? In the past year and a half?
No, I've owned it for a little while. I've added to it recently.
Well, that's what I mean, building it up to the size that it is now.
Yeah, I mean, kind of. I've added to it a bunch of times. The last couple times have been like maybe once this year, once last year, and those have been larger positions than when I started, but nothing crazy. Like I haven't really been like backing up the truck or anything like that. It's just been part of my regular buying process more recently in the past year or so than I think it had been before that. All right, so real quick, here is the 5-year chart using FinChat, our sponsor. Go ahead and check out the link in the show notes. So this one, unlike all the others we've talked about, Jason, has beaten the market over the past 5 years pretty handily, actually, about 215% compared to the market's 101%. That's total return, which is even more impressive because MercadoLibre doesn't pay a dividend. So its stock performance
used to pay an itty bitty one
well, it doesn't now. So that 215% is mostly stock appreciation, whereas
by far
the S&P 500 has the dividends reinvested in that total return. Either way, it's been a market thumping stock, and it's done well in my portfolio as well.
All right. So why do you own it? What's your one sentence thesis?
Latin America is a growing economy that needs banking and wants e-commerce, and MercadoLibre provides both.
Love it. What do you follow? What KPIs do you follow? Using our sponsor, FinChat's product.
Using our sponsor, FinChat, I will show you. So one of the things I track, so there's, like I said, there's the e-commerce side of the business, there's the fintech side of the business. There's other stuff they do. They run classified ads, and there's other things, but those are the two big buckets, I would say. So this is unique active buyers. So I follow this to see how the e-commerce marketplace is growing. So you can see their active buyers grows pretty nicely. This is a 24% compound annual growth rate going back to Q1 of 2023. So that grows pretty strongly.
Yeah. So just think about that. For the first quarter of 2023 to the quarter just ended, they have added 21 million new buyers.
Yeah. Right. So that's the first one. And then here we have gross merchandise volume. So this is just the total value of stuff that crosses the e-commerce platform, right? Again, growing at a CAGR of 30% going back to December of 2019, right? So this is what you'd love to see this. Here's another one, total items sold. Again, good progress, and number of items shipped. So like just on the e-commerce side of the house, these are a couple that I just follow every quarter. And this, every chart for the company pretty much looks like these. That's what's so impressive about MercadoLibre. On the fintech side, here's total payment transactions. So this is just the transactions on the fintech side of the house. It's a little bit wonky to follow some of these metrics. If you're looking on a platform like FinChat, they actually do a nice job of telling you when this happens, but they've changed how they calculate some of these things. So there's like the pre-2024, yeah, they recast it. But anyway, any way you look at it, this doesn't concern me because any way you look at the numbers, they look pretty good. And the one thing that I like is difficult about MercadoLibre is they give a lot of data. There's a lot of information that you can sort of track and keep an eye on, but it all pretty much heads up and to the right at almost all times.
Yeah, it is pretty remarkable. You built a business for e-commerce in a lot of countries and economies that are cash only. Makes it, okay, well, how the hell are you going to sell your stuff that's on the internet? We'll build a payments business. And they built a payments business and partnered with a lot of local merchants where people could take money and load their Mercado Pago accounts so then they could buy. And the Mercado Pago business, people are now using it for as much stuff off I track.
You know, for a company that's growing quickly, you would expect them to be spending a lot of money on that growth, right? And they are spending money on growth, but just a couple of metrics that really impressed me about MercadoLibre. Free cash flow per share. I'm going to show that one really quick. All right. So this is free cash flow per share, full year, from the full year of 2015 to the full year of 2024. So in 2015, it was $3.60 and it's $139.02 per share now. I mean, just incredible, as they've grown, just incredible cash flow here. And one of the other metrics, I can't show it because it's just something I track myself, but I like to track this for every company, but it's this one that I think is interesting for MercadoLibre, going back to what I was saying about growth. 2 years ago, their operating expenses were 37% of their revenue. Now it's 32%. And that's been ticking down pretty steadily at quarter after quarter after quarter. Everywhere I look for proof that the company's doing what I want it to do when it comes to MercadoLibre, I find it.
Yeah, no, I think that's not much else to say. So how's it, again, I think we've kind of already answered these questions, but let's ask them anyway. Has the business result been anywhere close to what you expected?
I think it's been better than I expected. I figured at some point there'd be a more prolonged sell-off or a significant problem. And I'm sure there will be at some point, but so far there hasn't been.
No, but in a very, very good way.
Yes. Yeah.
Yeah.
It's the poster child for like that company that just reports, you skim through their earnings and you're like, all right, looks great. Every quarter.
We've talked about, I don't want to gloss over it, but I know we're trying to focus on time here, but you and I have talked about with the fintech business, the lending aspect of it that has started to create more risk. And a quarter before the third quarter, they had some debt that they wrote down because of, issues with payment. But this fourth quarter, they just reported, kind of answered the bell on concerns about a lot of that. So why do you still own the stock?
Because it's awesome.
It's true. It's true.
But let's take the question differently. Let's build upon what you just said. I do think the biggest risk in my mind is what you just said. It's the debt aspect. And I think it's the debt aspect tied to the fact that some of the countries they are in are just more volatile economies, right? Like there's hyperinflation in some of the countries and just less established governments and things like that, right? And none of us have boots on the ground feel for MercadoLibre in these other companies, right? If Amazon struggles, we're all going to be aware of that because we live in America and Amazon is huge here. And I don't live in Argentina, Mexico, Brazil. To me, like the risk of this company is like things like debt, things like just risk of not being aware enough of what's going on in any of these companies that could really, whether it's a regulation risk or just a political destabilization risk or inflation or something like that.
Move fast and break through things works great for tech platforms and taking on risk as an entrepreneur. It is a terrible underwriting methodology for lending money. So the skill sets are very different. And I do feel like they've tried to get the right people and leverage things to be good lenders. But honestly, we're not going to fully know for multiple more years. I agree with that's probably the biggest risk. All right. Ring out your brain, Jeff.
Yes, I would buy it today. But the biggest reason I would is I still don't think it's that expensive. That's what I keep coming back to with this company. Like for a business growing its top line, in the 30 to 40 range consistently for years and years and years, you would expect it to trade at some insane multiple. It's expensive, but it's not really, really expensive. There are times when I look at it and kind of say to myself, I can't believe it's this inexpensive. So considering all the results, considering I don't think it's that crazy expensive, considering I still think has a huge runway for growth in front of it. I mean, that's an emerging part of the world in terms of the economies. Yeah, I would definitely buy shares today.
All right, there you go. It only took you twice as long as it did me.
No, I was only because I was showing charts.
You created value for showing those charts for the people that are listening to the podcast. Showing the charts.
We do a video podcast. I want people to experience.
Check us out on YouTube too.
Yeah. Or Spotify. Yeah. Spotify posts the videos.
That's right. Spotify videos. That's right. That's true. There you go. So you have choices. All right, Jeff, that was fun. Hopefully it was informative. And I would love to try this again.
Yeah, give us some feedback, listeners. If you like this, if you want something similar to this, maybe we can do different questions next time just to spice it up. But a quick look at the stocks in our portfolio, putting our mouths where our money is, or our money where our mouths are. I don't know.
Our mouths where our money is. That's exactly right. Yeah, we're talking our book, the lingo, as they say. All right, so tell the people how they give us feedback.
So the easiest way and best way to give us feedback is to first give us a 5-star rating on either Apple Podcasts or Spotify. That's step one. And then step two is then to give feedback any way you want. It could be a glowing review on Apple Podcasts. It could be a social media post. It could be an email. But we have it set up where nothing will actually reach us until there's a 5-star rating first. So that's step one.
Exactly. Okay. Thank you for clarifying that. That was good. All right. I'm going to wrap this thing up because we're getting goofy again. Folks, thank you so much for listening. We appreciate you riding along with us, but do give us feedback. If you have a strong opinion one way or the other, let us know what you think. And as always, we love to give our answers to these hard questions and try to help ourselves find some objectivity with our own portfolios and being honest with ourselves about the stocks that we own. It's up to you to figure out the same thing for your portfolio and what you own and if it's the right thing for you. But do it. Do the hard exercise. Ask yourself those hard questions. Poke. Try to disprove your thesis. You'll be a better investor for it. You can do it. I believe in you. All right, Jeff, we'll see you next time.
See you next time.